In 1932, imagine a farmer in Iowa walking into town before spring planting. His name could have been John or William or Henry. The exact name doesn't matter because thousands of families lived some version of this story. He needs seed. He needs feed. He needs a little cash to keep the farm alive for another season. So, he goes to the bank, not to borrow, to withdraw his own savings. But the doors are locked. Or the teller tells him withdrawals have been restricted, or the bank has suspended operations, while examiners decide whether it can ever reopen. The farmer has money in that bank, at least he thought he did. Then, the second letter arrives. His mortgage payment is overdue. The bank, or the receiver, or the holder of the note, is moving toward foreclosure. The farmer cannot get the money the bank owes him, but the bank can still demand the money he owes the bank. And if he cannot pay, it can take the house, the barn, the land, the equipment, and the future crop that was supposed to save him. That is the one-way contract at the heart of the Great Depression. The next time someone tells you a bank deposit is just money sitting safely in your account, remember this. Legally, a deposit is not a box with your name on it. It is a debt. You have lent money to the bank. And in a crisis, the difference between the debt you owe and the debt owed to you can decide who keeps the farm. This is the story of the Great Depression's one-way debt trap. It is also the story of Milo Reno, the Iowa farm organizer who watched banks enforce debts against farmers, while the banking system itself was failing to honor its own promises. Reno did not invent the crisis. He did not solve it. But he gave the anger a language. If the banks could have a holiday, he asked, why couldn't farmers? If bankers could shut their doors, why couldn't farmers stop sending food to market? And if a bank could refuse to pay depositors today, why did a farmer have to lose his land today? To understand why this felt so outrageous, you have to start with a legal distinction that sounds boring until it destroys a family. Secured debt and unsecured debt. A secured debt is backed by specific property. If you borrow money to buy a farm, the mortgage is secured by the farm. If you do not pay, the lender does not merely have an abstract claim against you. It has a claim against the land itself. It can foreclose. It can force a sale. It can turn the promise into property. That is what made farm mortgages so dangerous in the early 1930s. The debt was written in dollars. The farm was pledged as collateral. If crop prices fell, the number of dollars owed did not fall with them. Wheat could collapse. Corn could collapse. Land values could collapse. But the mortgage remained. The farmer's debt was secured. The bank had teeth. Now look at the other side. When you put money in a normal bank account, you're not usually storing specific dollar bills in a vault. You are becoming a creditor of the bank. The bank owes you that amount. But before federal deposit insurance, if the bank failed, your claim was generally unsecured. You did not have a lien on a particular pile of cash. You did not own a specific desk, safe, building, or loan portfolio. You had a claim in the line of creditors. If the bank's assets were worth enough, you might eventually get paid. If not, you might get a fraction. If the bank closed and never reopened, your savings could disappear. So here's the cruel asymmetry. The farmer's debt to the bank was secured by the farm. The bank's debt to the farmer was often unsecured. The bank could reach through the mortgage and seize real property. The farmer could not reach through his deposit slip and seize the bank's assets. One promise had collateral, the other had hope. This was not just a technicality, it shaped the Depression. During the 1920s, many American farmers were already in trouble. The war boom had encouraged production and borrowing. Land had been expensive. Equipment had been purchased on credit. Mortgages had been taken out when prices looked as if they might stay high. Then agricultural prices fell. By the time the Great Depression arrived, many farmers were not beginning a crisis. They were entering the last act of one. The price of what they sold collapsed. The cost of what they owed stayed fixed. That is debt deflation in human form. You owe the same dollars, but the dollars become harder to get. A mortgage that once looked manageable becomes a trap. A loan that once required a few wagon loads of crops now requires twice as much work, twice as much land, twice as much luck. And every year, the farmer waits. Interest accumulates. Taxes accumulate. Equipment wears out. The soil still needs seed. So return to our farmer. He needs money to plant. His account at the local bank says he has savings, but the bank is closed or limited or in receivership. If he cannot buy seed, he cannot produce a crop. If he cannot produce a crop, he cannot make the mortgage payment. If he cannot make the mortgage payment, the lender can foreclose. So the bank's failure to pay him makes it harder for him to pay the bank. Then the bank punishes him for not paying. This was the kind of circular cruelty that made ordinary people stop seeing the system as neutral. Between 1930 and 1933, more than 9,000 banks failed in the United States. Before federal deposit insurance, bank failure was not an inconvenience. It could mean the loss of a lifetime's savings. Depositors lined up outside banks because they understood the hierarchy instinctively. The first people out might survive. The people at the back of the line might not. A bank run looks irrational from a distance. Up close, it can be perfectly rational. If you believe your bank cannot pay everyone, then waiting politely is just volunteering to be last. But when everyone tries to be first, the bank can fail faster. That was the nightmare. Every depositor wanted safety. The pursuit of safety destroyed the institution that promised it. And while depositors waited outside locked doors, debts to those same banks, or to the creditors who held their loans, did not simply vanish. The Depression was full of broken promises, but not all broken promises were treated equally. In rural America, the foreclosure auction became the public ritual of that inequality. A farm family could spend years building a place. The house, the animals, the tools, the land, the orchard, the fences, the memories, all of it could be converted into lots at auction. The auctioneer would call out the property. Neighbors would stand around watching a family's life priced in public. A horse, a plow, a wagon, a table, a few acres, a house. The purpose was legal and financial. The lender wanted to recover what it could. But socially, it was explosive, because the crowd could see the imbalance with their own eyes. The bank's claim on the farm was enforced in public. The farmer's claim on the bank was invisible, delayed, and often compromised. One side had the sheriff. The other side had a passbook. This is where Milo Reno enters the story. Reno was born in Iowa in 1866. By the time the Depression hit, he was an older man with deep roots in farm politics. He had led the Iowa Farmers Union. He believed farmers were being crushed not because they were lazy, but because prices, debts, railroads, banks, and policy had trapped them. In 1932, he helped lead the Farmers Holiday Association. The name was deliberate. Banks were taking holidays, so farmers would take one too. The idea was simple and radical. Stay at home, buy nothing, sell nothing. If farmers withheld their products from the market, perhaps prices would rise. If they acted together, perhaps creditors and politicians would have to listen. This was not polite lobbying. In parts of the Midwest, farmers blocked roads. They stopped trucks. They dumped milk. They tried to prevent products from reaching market at prices they believed meant ruin. And at foreclosure auctions, they developed one of the most dramatic tactics of the Depression: the penny auction. When a neighbor's farm or equipment was being sold, local farmers would gather in force. They would bid tiny amounts, pennies, nickels, a few dollars. Anyone who tried to bid a real price could be shouted down, intimidated, or worse. At the end, the property would be sold for almost nothing. Then, it would be returned to the farmer. Legally, this was an attack on the auction process. Morally, the farmers saw it as self-defense. If the law allowed a bank to take a farm when money itself had stopped working, then the community would make the law unenforceable. The penny auction was not just about one farm, it was a public statement. You cannot collect full value from us, while the financial system pays partial value to us. You cannot demand perfect performance from borrowers, while depositors are told to wait. You cannot turn every debt owed by ordinary people into an iron law, and every debt owed to ordinary people into a maybe. This is what made the Great Depression banking crisis more than a banking crisis. It became a legitimacy crisis. People can survive hardship if they believe the rules are fair. They can survive loss if they believe everyone is sharing it. But when the rules seem to harden in one direction and soften in the other, anger becomes political. The farmer did not need a law degree to understand secured and unsecured debt. He understood it when he could not withdraw his savings, but still faced foreclosure. He understood it when a bank examiner could close the bank's doors, but the mortgage documents remained open. He understood it when the lender's claim had land behind it, while his claim had only a promise. And once enough people understood that, the old banking order could not survive unchanged. By early 1933, the crisis had moved from local tragedy to national emergency. State after state imposed bank holidays or withdrawal restrictions. Depositors hoarded cash. Confidence drained out of the system. When Franklin Roosevelt took office in March 1933, the American banking system was close to paralysis. On March 6th, he declared a national bank holiday. For several days, the entire system was shut. This was extraordinary. The government was effectively saying, the private promises inside the banking system have become so fragile that normal contract enforcement cannot continue. Banks would be examined. Some would reopen. Some would not. The point was not merely to stop panic. It was to decide which promises could be made believable again. Then came the deeper reform. Federal deposit insurance. The FDIC, created in 1933, changed the meaning of a bank deposit for ordinary people. It did not make every bank safe. It did not make every financial crisis impossible. It did not abolish inequality between debtors and creditors. But it addressed the most politically explosive part of the old system. It told ordinary depositors, you are no longer merely an unsecured creditor hoping the bank's assets are enough. Up to the insured limit, the government stands behind your claim. That changed behavior. If depositors believed they would be paid, they had less reason to run. If they had less reason to run, banks had a better chance of surviving temporary fear. Deposit insurance was not just technical plumbing. It was a response to a moral problem. People had discovered that the money they thought was theirs could become a frozen claim in a failed institution. The government had to make that claim feel like money again. Mortgage relief moved in the same direction. The New Deal did not simply trust the old creditor-debtor machinery to grind through the Depression. It created institutions to refinance mortgages, slow foreclosures, and keep people on land and in homes. Again, the point was larger than compassion. A society cannot function if every contract is enforced to the letter in a world where the monetary system itself has broken. If prices collapse by half, incomes collapse, banks fail, deposits freeze, and credit disappears, then insisting that every old debt be paid exactly as written becomes a recipe for mass dispossession. That does not mean debt is fake. It means debt depends on the system around it. And when that system fails, the question becomes political. Who absorbs the loss? The borrower, the depositor, the bank shareholder, the creditor, the taxpayer? The answer is never neutral. It reveals who the system exists to protect. That is why the story still matters. Modern bank accounts are safer than they were in 1932. Deposit insurance exists. Banking supervision is stronger. Central banks can provide liquidity. Governments know how dangerous a total banking panic can become. But the underlying question has not disappeared. In every crisis, some promises become sacred and others become negotiable. In 2008, homeowners learned that mortgage contracts could be enforced even while the financial institutions that created the crisis received emergency support. In 2020, asset markets were rescued at extraordinary speed while many ordinary households waited for relief. In more recent bank failures, depositors again learned to ask exactly what kind of claim they had, who stood behind it, and whether the official insurance limit was the real limit or just the written one. The old distinction is still there: secured creditor, unsecured creditor, collateral, guarantee, priority, backstop. These words sound like paperwork until the system breaks. Then they become the difference between being paid, waiting, or losing everything. So return one last time to the farmer. He has a mortgage. That mortgage is secured by land. The lender can point to the farm and say, "If you do not pay, this is ours." He also has savings in the bank. That deposit is the bank's debt to him. But before deposit insurance, if the bank failed, he could not point to a specific asset and say, "This is mine." He stood in line with other creditors. The bank's claim against him had a house behind it. His claim against the bank had a ledger entry behind it. That is the whole tragedy in one sentence. When he owed the bank, the debt was secured by his home. When the bank owed him, the debt was unsecured by almost anything he could touch. And that is how a bank could owe you money and still take your house. Milo Reno and the farmers who followed him did not use the language of balance sheets and creditor priority. They used the language of survival. They blocked roads. They gathered at auctions. They bid pennies. They returned property to neighbors. They were saying that a financial contract without reciprocal obligation had lost moral force. The system answered eventually, not by proving them wrong, but by changing the rules. Deposit insurance, bank holidays, mortgage refinancing, foreclosure relief. The reforms admitted something the Depression had made impossible to ignore. Money is not just a private promise, it is a public trust. And when that trust breaks, the law can keep collecting for a while. But legitimacy starts to disappear. The lesson of the Great Depression is not that debts do not matter. It is that the order of debts matters. The collateral matters. The guarantees matter. The enforcement matters. And in a crisis, the most important question is not just how much is owed. It is whose claim gets treated as money and whose claim gets treated as a request to wait. That question decided the fate of farms in the 1930s. It still decides who survives a financial crisis today. Thank you for watching. If you enjoyed this documentary, it would mean the world to us if you like the video or subscribe to our channel. We truly believe that understanding the past is key to navigating the future, and by studying financial history, you are better prepared to safeguard your wealth than 99% of the people out there. If you have any questions or remarks, or would like to request a video topic for our next deep dive, please leave a comment down below. We aim to reply to all of them.